we're doing the financial alphabet, and today we are at C for classes. I'm specifically going to look at ASSES specifications and categories for asset classes. We visit assesa.org.za. We land on this page. And if we read there quickly, the Association for Savings and Investment South Africa represents the collective interests of the country's asset managers, collective investment scheme management companies, which are unit trusts, linked investment service providers, multi-managers, and life insurance companies. You understand why they're important. They are the regulatory body. So they govern this industry and they set certain standards. And that's what we want to look at today, so that you can understand how to compare and why it is important to understand the different fund managers that you are invested in. We go to standards, guidelines, and codes, and we go to standards, and we go to the ASSESA fund classification standard. You will see that it opens up a PDF document, which is loading at the moment. Then, if you scroll down, because there's many pages, and it tells you all about their objectives, you get to this section called the detailed subcategories of second tier of classification. Now, all I wanted to tell you here is about the different sectors, which is the equity portfolios, multi-asset portfolios, interest-bearing portfolios, and real estate portfolios. There's also offshore and worldwide, but for now I'm just going to focus on these four just to get the point across. So if you are buying a fund in the equity portfolio sector or classification or category or class, whatever you want to refer to, you'll see there's a various different ones there. There is a general, a large cap, mid and small cap, resource, financial, industrial, unclassified, and general Africa. So if you're buying a fund manager in the general equity sector or category, you can't compare it to some fund manager in the resource classification or industrial or even large cap, because they won't have the same mandate. They won't have the same guidelines that they have to adhere to, same benchmarks they have to follow, nothing. Same goes for multi-asset portfolios, which means many assets in one portfolio. If you buy a balanced fund, for instance, they usually fall in the high equity sector, which means they have high equity, but they have other assets too, cash, bonds, property, offshore, all of that built into that. And it's regulated according to how much they can put in what area. So if you can't have something in there, you can't compare it to a equity portfolio because this is pure equity, while this will have cash and bonds and stuff in there as well. Also, if you buy a multi-asset low equity, it means that it's got lesser equity and higher cash and bond allocations. So you can't compare that to a high equity multi-asset fund, for instance. Same goes with interest bearing. If you buy something in the variable term or short term, which means it's got short-term bonds in there, short-term duration bonds, you can't compare it to a money market instrument where there's only cash involved. And you can't compare a real estate equity fund to a normal equity portfolio. So yes, it's important to understand that when you look at your unit trust portfolio, you will be invested in various different funds. And if you have one equity fund and you compare it with another fund's performance, you have to understand that they might fall in different sectors. And that's why they don't perform the same, because of the fact that their rules are different. Now, even in the sector itself, if you go equity general, for instance, you could even have differences underlying in that too, because some funds might choose to only invest in local domestic equity, whilst another fund in the general equity sector might decide to expose them to some foreign or worldwide equities as well, stocks as well. So it's good to understand your underlying fund so that you compare it fairly, so that you don't on a year-to-year basis or even longer or shorter terms want to replace a fund just due to its underperformance, and it might be the wrong time because you don't understand that that fund is invested in something to correlate or balance out whatever you have in one of your other funds. So this is what as advisors and coaches do and look at and understand and study, and fund managers look at and understand and study in order to build a portfolio that complement each other and that's got a little bit of everything in there so it balances out over the long term. And yes, we're back to that word, diversification. That's what it's all about.